What is up, my multifamily machinists, my small axers, my multifamily lovebirds? What's going on? It's Nico here, guys, and I'm here to chat a little bit about today's environment. So, today I want to talk about something that I think a lot of people in real estate are just flat out missing. Everybody keeps asking, is multifamily crashing? Is the market falling apart? And I think the real answer is something different. What we're actually seeing today is a reset, not a demand problem, not a debt problem. Right now, roughly 6 to 7% of multifamily CMBS loans are delinquent. That's one of the highest levels that we've seen since the pandemic. At the same time, we are experiencing one of the largest apartment construction booms in decades, which pushed vacancy rates up in many markets. And then on top of that, interest rates went up faster than they have in 40 years, 5 full basis points within 1 year. So when you combine higher debt costs, more supply hitting the market, and loans coming due, you get stress. But stress in real estate markets often creates the best buying opportunities for people like you and me who are still involved in the game. So today I want to walk you through what's actually going down, what's happening right now, where the opportunity is, where to get the best data, and what investors should be thinking about right now. There are three big forces colliding in multifamily right now. The first one is the interest rate shock. That is no shocker to us because it's been around now for 3, maybe 4 years at this point. From 2020 through 2022, borrowing money was historically cheap. Multifamily loans were getting done at 3%, sometimes even lower than that, and deals were penciling differently. So today, many of those same properties are refinancing closer to 6.5%, sometimes 7%, even more than that. That dramatically changes how you look at deals, how you underwrite your deals, and how a deal will work. A deal that worked when the annual debt payment was $2 million might have a debt payment today of closer to $3 million. And suddenly, the property can't support that type of a loan. So when lenders are tightening up, they look at DSCR a lot more carefully. They're underwriting more conservatively, handing out less proceeds, meaning you have to come out of pocket with a lot more money, a lot more equity today just to get a deal done, just to get a deal to cash flow enough for the debt to be covered. Because banks know today that the debt environment has changed. If there are significantly more loan delinquencies, they are going to be more cautious. The second big force that we're seeing today is the supply surge. From 2021 through 2024, developers went on a building spree. Cheap debt plus strong rent growth made new construction extremely attractive, and developers delivered hundreds of thousands of new apartment units across the country. And that forced vacancy to increase in many markets. You see it especially in places like Austin, Phoenix, Nashville, and in parts of Florida too. But here's the interesting twist: developers today have now pulled way back. So we had about 500 units delivered in Lakeland, Florida over the past year, and only 96 were absorbed, which is terrible. But new construction is way down. There are very few permits to build new construction in the future. Construction financing is expensive today, permits are slowing down for sure, and new multifamily starts have dropped dramatically, which means that in a couple of years, we may actually see supply tightening again. And real estate always moves in cycles like this. So you have to capitalize on the opportunity today, understanding that it's not a great environment to operate in today, but maybe if you can buy at a discount, and then when demand increases 2 to 3 years from now, you will be in an excellent position. That never means that you should be buying at a negative cash flow basis. You should never buy when your property is not cash flowing. You have to ensure that it cash flows under today's environment, knowing the risks, knowing what could go south, knowing what could get worse. Maybe occupancy could decrease even more. Understanding that and going in and underwriting and analyzing that way prior to actually purchasing the property, purchase it at the basis that makes sense for you under those conditions. And when the market shifts again, which it will, 2, 3, 4, 5, maybe 7 years, you can capitalize on that. The third factor that I want to talk about is loan maturities. Between 21 and 22, many investors bought deals using short term bridge loans. These are usually 3 year loans, sometimes 5. and many of them had floating interest rates. You could buy rate caps, but not everybody did, and those rate caps didn't help everybody. So as interest rates went up, their loan payments increased too. 5 basis points over the course of 1 year. Historically insane. Now, what happens when those loans are due? A lot of operators just can't refinance. The property is not worth the loan. That's crazy to say, but it's true, which means that today buying is at a discount. But for those operators that purchased and their properties are not worth the loan today, this leads to capital calls, forced sales, recapitalization, or lender workouts, something we call extend and pretend. You try to get extensions on your loan and pretend that everything's okay. Banks are getting tired of that. We know that banks do not want to own properties. They are not in the business to be landlords. They are in the business of lending money and getting a return on their funds. So they will do whatever they can. Yes, extend and pretend to a certain point, but eventually a bank might foreclose on the property and accept a loss. So, where the opportunity actually is, we have to remember that not all distress leads to good deals. You have to know where to look. The first place is bridge loan failures. A lot of deals purchased in 21 were based on aggressive assumptions. So the plan was usually something like this: buy the property, renovate the units, push rents higher, then refinance into long term debt. But when interest rates jumped, that refinance became much harder. And on top of that, people were underwriting for aggressive rent growth. Yeah, we saw 15 or 16% for 2 years in a row in some markets, but that is unsustainable, unrealistic. Now, today, rents are flat or negative in many markets across the United States. And if renovations took longer than expected or the rent growth did not happen fast enough, which we are now seeing, the business plan stalled. So those owners are now under pressure. Sometimes they need to sell. Sometimes they need new capital. That's where buyers can step in and acquire properties at below replacement costs sometimes. Another opportunity that people tend to overlook is capital stack restructures, and some people are capitalizing on this. So sometimes the property isn't being sold, but the capital structure is breaking, and maybe LPs don't want to put more money in. So maybe the sponsor needs additional capital to stabilize the deal. In those situations, new investors can sometimes buy into the deal at a discount. You're essentially stepping into a stressed capital structure that can create opportunities to buy equity for far less than the original investors paid back in 2021. The third opportunity that I see today is smaller operators under pressure. Some mom and pop owners refinanced during the low interest rate period, but today they're dealing with rising expenses. Insurance costs are higher, property taxes are higher, maintenance is higher, delinquency is up, debt is more costly. And after a few years of that pressure, some owners simply decide it's just time to sell. These deals often show up as off market through broker relationships or direct outreach. So make sure you're either calling owners constantly or talking to brokers constantly or doing both. Many brokers will present you with off market opportunities or pocket listings just because they don't want to go through all of the trouble of creating an offering memorandum. If you have a good relationship with them, they might present those to you. So stay engaged. The fourth opportunity that I see is temporarily oversupplied markets. Now, oversupply is a real thing. Some cities built up way too much during the housing boom, just like my market, Lakeland, Florida. But those same markets still have strong fundamentals: population growth, job growth, migration. And if you buy during temporary supply surges like this, you might be buying right before the next rent growth cycle. That's the long game in multifamily. That's how you have to think. It could be scary, it could be risky, but make sure you buy at a good basis, and then you can capitalize on things like that. Now, let's shift a little bit to talk about where you can find good data, because data is crucial. If you want to invest intelligently, you have to be following the data. One tool I like to use is CoStar. CoStar lets you track vacancy rates, rent growth, supply pipelines, and sales comps. It gives you a clear picture of what is happening in a specific market. You can even get rules of thumb for expenses. It is epic. Another great resource is TREP, TREPP. TREP tracks commercial real estate loans, so you can see delinquency rates, loan maturities, and where distress may be building in the debt markets. Another good source for data is Yardi Matrix. They publish research on rent trends development pipelines, and national multifamily data. These kinds of reports help you understand where the market might be heading. Now, let's shift again to talk about something very important, the geopolitical wildcard here. It's another factor that investors may be overlooking, geopolitics. Conflicts in the Middle East can affect oil prices, and oil prices affect inflation. If oil spikes, that could lead to higher inflation and potentially higher interest rates again. But it also increases construction costs. And when construction becomes more expensive, developers build fewer new projects, which can tighten housing supply even more down the road. So, ironically, geopolitical instability can sometimes slow future supply and support rental housing demand in the future. Let's not get too crazy on this topic, though, because I do not have a crystal ball and neither do you. But here's how I see things playing out. I don't believe we're heading towards a housing collapse. Demand for apartments remains strong. In many cities, it's significantly cheaper still to rent than to buy a home. Make sure you buy your apartment buildings in those areas. And the United States still has a housing shortage overall. So the issue right now may not be demand, it may more fall on the debt. And when debt stresses and when debt stress forces investors to sell or restructure their deals, prices reset, which is what we are seeing. And that's when investors need to step in. But again, it's difficult to put the capital together. You're going to have to come out of pocket with more equity, which makes the deal even more challenging. But in the long run, you will succeed if you buy at the right basis today. Most people wait for perfect market conditions, which never happens. And it is nearly impossible to time the bottom to time the top of the market cycle. But you have to capitalize on what's happening right now. There are definitely discounts. Real estate investors decide to act or they just decide to stay on the sidelines. Right now, we're seeing a reset in multifamily pricing. There's no doubt. And resets create opportunity for people like you and me. Because at the end of the day, reading about deals does not make you an investor. Buying buildings does.